China announces new support measures to boost its economy. Oil prices gain amid rising tensions in the Middle East and supply concerns. And India accuses China of highly opaque economic practices and declines to join its trade pact. Hello, I'm Taiba Aydin with the latest business and finance news here on TRT World. Chinese stocks surged on Tuesday after the central bank announced a slew of new measures to help boost its economy amid concerns that the 2024 growth target of around 5% may be out of reach. The People's Bank of China, or PBOC, will cut the reserve requirement ratio for banks by 50 basis points, although it did not provide a specific timeline. It also announced it would cut the 7-day reverse repurchase rate from 1.7 to 1.5%. PBOC Governor Pan Gongsheng said in a rare briefing that the bank could cut loan prime rates by 0.2 to 0.25%, but didn't specify whether he was referring to the 1-year or 5-year. The 1-year loan prime rate currently stands at 3.35% and 5-year LPR is at 3.85%. Other measures also include reducing down payments for second homes, as well as $140 billion of long-term funds. Let's get more on this now with George Khoury in Dubai. He's Global Head of Education and Research at CFI Group. Good to see you, George. Now, how could this help ease China's economic troubles at the moment?
Good morning, Taiba, and thank you for having me today. We have seen similar measurements being taken by the Public Bank of China and Chinese government as well, maybe around 6 or 7 months ago, where they reduced the required rate of reserves for banks by also around 25 basis points. So it's not much surprising given the struggle that is happening in the Chinese economy recently, and especially due to the tariffs and increase in tariffs and sanctions that were happening on the Chinese technology and Chinese exports to the West as well, which basically we already know that the West is one of the biggest demanders of Chinese supplies historically. I believe for the upcoming period, it's not just about the measurements that will support the economy in China. It's more about the trust from the foreign investments. We have seen a lot of reduction in foreign investments that we're pulling into the Chinese market for the past 2 years approximately. And this is what has reached the Chinese economy to that current point, which is what we're seeing currently. However, the measurements, of course, will support, especially from the mortgage perspective, by reducing the down payments, by reducing the rates gradually, and eventually, due to these cuts and measurements, the banks eventually would have to be forced to reduce the interest rates on the mortgage loans as well, which eventually might increase the demand. But again, I say it, and it's very clear, based on what we have seen for the past 1 year in China, the trust needs to be gained from the foreign investors, and this is what will regain or re-push the Chinese economy to the previous levels.
Right, I want to ask you about the property sector now. Is anything being done there?
Yeah, exactly. What we have been discussing mostly now is the reduction in interest rates or possibility of reduction in interest rates, which will be mirrored on the mortgage interest rates on loans, mortgage loans, basically, which could increase the demand. Also, reduction in the down payment for new home buyers as well. This will also increase the demand on new mortgage. However, we're looking at it from the bright side, but from another hand, we cannot dismiss the actual fact that currently we have a lot of construction companies that are issuing for bankruptcies. And we've seen that for the past 1 year or 2 years, or even before, for 3 years since COVID started. So in order to increase the demand with the current supply that we have in the market and people not being able to actually buy these properties, whether commercial or retail at the same time, this is where the break-even should happen. I think it's going to take some more time to reach that phase.
All right, George Khoury, Global Head of Education and Research at CFI Group. We'll have to leave it there. Thank you very much for your analysis. Oil prices increased on Tuesday, bouncing back from prior losses as the prospect of supply disruptions outweighed concerns about sluggish demand. This comes as worries persist about weak demand in the Eurozone and uncertainty over China's fuel consumption. Brent crude futures for November were up 69 cents, or about a percentage point, to $74.59 a barrel. US WTI crude futures for November also rose 74 cents to just over a percent to $71.11. China's recent monetary stimulus, including cutting banks' reserve requirement ratios, is offering much-needed support to the oil market. Traders had been hoping for measures to jumpstart China's slowing economy, and this move is seen as reducing risks to oil prices. The oil market is sensitive to geopolitical tensions in the Middle East, a critical region for global oil supply. Growing tensions between Israel and Hezbollah in Lebanon are a huge concern, with fears that the conflict could escalate further, drawing in major oil producers like Iran. Investors are also watching weather developments in the US Gulf Coast, a major hub for crude oil production. Hurricanes have historically resulted in significant short-term spikes in oil prices, affecting global markets. The looming hurricane in the Gulf of Mexico threatens to disrupt US oil production, adding further upward pressure on oil prices. Christoph Ruhl is a senior research scholar at Columbia University's Centre on Global Energy, and he joins us now from London. Good to see you, Christoph. Now, how have escalating tensions in the Middle East impacted energy prices?
Good morning. Well, as you mentioned, the Middle East is one of the centers of global oil production and the center of global oil exports. So any kind of increase in geopolitical tensions has an upward drift on oil prices. And then when you see bombs flying and rockets flying, and the possibility, or actually probably already the reality, of armed combat in that region, then that exercises additional pressure. And if it potentially involves one of the larger oil producers or exporters like Iran, then that tension goes up significantly as well. So the answer is very clear that we have for a while now observed fluctuations around a long-term trend, which were driven by these tensions in the Middle East.
Right, and there's another region that's a cause for concern, and that's the US at the moment. What potential risks could a hurricane in the US Gulf Coast pose to crude oil production?
It's a risk, but it's a different kind of risk because it's foreseeably a short term. It is clear that even the worst hurricane is over within a few days or weeks. And it is an exercise which could be important because it affects hoarding and affects the need to store oil and of oil consumers to be prepared by buying more oil in advance. But the end is always in sight. Everybody knows the basic routine of a hurricane. Even if the outage is large and the price adjustment is large, the degree of uncertainty associated with the hurricane season is less than the degree of uncertainty associated with a war which may spin out of control. That, I would say, is the basic difference.
Right, and we touched on China's latest stimulus measures earlier in the show. How significant are these for global oil demand?
I think we have to distinguish two things. One is the focus on China, which is very pronounced among oil analysts. I'm not quite sure why. China has come down from this exorbitant, very high double-digit growth rates to a region of 4 or 5%. What matters in China is that there is no crisis developing which spins out of control. China, in my view, has enough financial firepower and enough economic knowledge to manage the economy to avoid a bigger crisis. That means the upside for China is more likely to be stabilization and maybe growth of 5.5% or 6% instead of 4.5%. But the upside is not a return to these 13 or 11% which we have seen in the past. And I would think that the Chinese economy is doing fairly well, and that oil demand there hasn't been declining as much as people think, because there's a lot of unrecorded imports from Russia and so on. The other thing I would like to point out is there is a long-term trend in oil prices, and it points downward. And the reason is because expectations are that at the end of this year, and then certainly in 2025, global oil supply will be larger than demand. So everybody looks forward to next year and thinks prices are lower, and that helps to keep a lid on prices today. And the other reason is that in the long term, oil demand is no longer growing, will no longer be growing at the rates we were used to, simply because our use of oil has become so much more efficient and because of the introduction of electric cars.
That's very interesting, Christoph. Now, Europe is also another major importer of energy. How does declining business activity there affect energy market outlook?
Europe is a very interesting case for oil markets because despite rapid population and economic growth, oil consumption in Europe has peaked in the late 1970s. Since then, it's falling very gradually. So the answer to your question is that a decline in European business activities has a minor impact on oil markets compared to China or the US, or Asia and the US. And the longer term lesson to be learned from Europe is that we should look forward to a world in which oil demand stops growing, maybe not falling off a cliff like people think when they hear the word big oil, but declining very gradually, as has been the case in Europe, while economic activity continues to grow. It is possible.
All right, Christoph Ruhl, we'll have to leave it there. Thank you very much for joining us.
My pleasure.
Now, a quick look at some of the other top business stories from around the world. Boeing has made a so-called best and final offer to its 30,000 striking machinists, increasing its pay offer to 30% over 4 years and offering a $6,000 ratification bonus. The union criticised the offer, stating it was made without negotiation and not allowing enough time to present details to members. Boeing's offer is contingent on approval by Friday, but the union has refused to vote on the 27th, opting instead to survey workers for their opinions. The US Department of Justice plans to sue payment company Visa for allegedly monopolizing the debit card market, accusing it of anti-competitive practices. This lawsuit follows a DOJ investigation into Visa's debit card practices initiated in 2021. Visa's rival MasterCard and Discover's Pulse network have faced similar antitrust cases related to competition in the US debit card market. Former President Donald Trump has threatened to impose a 200% tariff on John Deere if it shifts production to Mexico. The agricultural machinery manufacturer has already laid off workers in Illinois and Iowa and is acquiring land in Mexico to move some of its production there. Despite this, the company maintains its commitment to US manufacturing, having invested $2 billion in domestic plants since 2019. Meanwhile, shares of Trump Media and Technology Group dropped over 10% after its lockup period expired, hitting its lowest level since going public in March. Despite the expiration, former President Trump stated he has no plans to sell his stake, emphasizing his commitment to the company. Shares have fallen about 20% since Thursday, far below their peak of $79 per share. India has made a bold decision to stay out of a deal that could shape the future of global trade. But what does this mean for its economy? Malik Fuda reports.
India has ruled out joining the world's largest trade agreement, the Regional Comprehensive Economic Partnership. The deal, signed by 15 Asia-Pacific countries, accounts for about 30% of global GDP. But India says it's not in its best interest to join. Indian authorities also claim that this deal doesn't support the country's farmers and small businesses.
India is not going to join the Regional Comprehensive Economic Partnership because neither did it reflect the guiding principles on which the Association of Southeast Asian Nations was started, nor is it in the nation's interest to do a free trade agreement with China.
India had been involved in the RCEP negotiations from the beginning. Talks started back in 2013, and many believed India's involvement would balance China's power. But by 2019, India walked away, citing unresolved issues and focused on building trade on its own terms. Indian officials accused China of flooding markets with cheap products that don't always meet quality standards.
Certainly nobody back home would like to have the Federal Tax Authority with a non-transparent economy very opaque in its economic practices.
But India isn't just stepping away from deals. It's also looking to create new opportunities. One of the big ideas is to become a key player in the semiconductor industry. As the world looks to diversify supply chains, India is positioning itself as an alternative to Taiwan for chip manufacturing. The country expects the demands for chips to reach $100 billion by 2030.
We are encouraging the semiconductor industry in a big way. We started building up the ecosystem, which is essential before we can see more and more foundries come into the country for the actual chip making.
India may be staying out of economic partnerships, but it's not stepping away from global trade. The government believes that joining a deal with China could harm its own businesses, and the country has chosen a more cautious path. It's investing heavily in sectors like technology with a goal to become a global chip-making hub. This could attract billions of dollars in foreign investments and create countless jobs. And until then, the world will be watching to see if the strategy pays off. Malik Fouda, TRT World.
Let's get more on this now with Sana Hashmi. She's an author and a fellow at the Bush China Foundation. Good to see you, Sana. Now, why has India decided against joining the Regional Comprehensive Economic Partnership?
Thank you. It's not a new decision, of course. This is something that we have been seeing at least since 2019 when India actually withdrew from the RCEP. But we all know that China is a major factor behind India's withdrawal from the RCEP. And of course, concerns over China's influence in the region, specifically how China is using economic coercion, is definitely playing an important, significant role as India is seeking to avoid becoming too reliant on China as well as on a trade bloc where China is definitely going to be a dominant player. Then India is also worried that joining RCEP would worsen its trade deficit, and with China, it is already above 70 billion. So this is something that India is already facing. That's a huge problem. That's a substantial surplus with China that India has. And of course, there are fears that increased competition from cheaper imports from China would harm local industries in India. So there are a number of reasons why India withdrew from it, but China's economic coercion and how China uh, dependence on China could be worsened is one of the major factors why India is not in RCEP, and we are not going to see any decision in favor of joining RCEP anytime soon.
And how does India's approach to trade with China influence its broader economic strategy?
I think India, as widely said, and it's kind of prevalent idea that India is adopting protectionist policies with respect to its broader economic strategy. I don't think that it's actually true. What India is trying to do is to focus on how to diversify away from China. And we have seen with respect to Taiwan, with respect to Australia, and now also with respect to India, that how China is using this economic interdependence, this economic over reliance to kind of achieve its political objectives. So this is something that is very much inherent in India's thinking with respect to its economic policies as well. So what India has been doing specifically under Modi administration is to go for self-reliance. We have seen opportunities and policies such as Make in India, such as self-reliant India. So the idea is to focus on building industries that India was really not focused on before. And sectors such as electronics, textile, semiconductor, these are the sectors where India is definitely strengthening its position and where there's more emphasis on self-reliance and as well as on diversifying and forging regional partnerships.
Right, and India has hopes to establish itself as a semiconductor hub. What steps is it taking at the moment to achieve this?
I think India has taken a number of strategic steps to establish itself as a global semiconductor hub. Of course, these are very recent steps, and the initiative is also at a very nascent stage. But what India has done in the recent past is to introduce initiatives such as production incentive initiatives, production linked incentives, providing subsidies. India has made substantial investment to establish its semiconductor industry, and a few years ago, it was announced that India is going to spend more than 10 billion investment in the semiconductor industry. But apart from that, India is also quoting some of the major companies from Taiwan, the US, and now Modi is visiting the US, and we saw how Prime Minister Modi had meetings with tech CEOs, with major semiconductor companies in the US. So there is definitely a lot of focus on investment in R&D, skill development, as well as infrastructure development. This is something that we have been hearing from companies that there's not a lot of infrastructure development to set up semiconductor fabs and to improve logistics. So I think the idea is to strengthen and invest more to support the supply chain. So this is what India has been doing, and these are just at very early stages, but I think this is definitely moving um, towards a positive direction.
And do you think India can realistically compete with the likes of Taiwan and China in their semiconductor markets?
I don't think that India is competing with Taiwan or even with China in the semiconductor market. What India is trying to focus is on just to perhaps learn from the strength of Taiwan. Perhaps cooperating with China is not on the card for very obvious reasons, but definitely India is definitely looking at the companies from Taiwan, from Japan, and from South Korea. And to get technology for advanced manufacturing capabilities to strengthen supply chain and to perhaps attract more talent pool from these countries. So I don't really see that there is competition, but I do feel that there is definitely more cooperation. India definitely faces significant hurdles in attempts to establish its semiconductor industry, but a combination of government incentives, strategic partnership, and a focus on building a robust ecosystem is definitely making it a viable player in the semiconductor industry. And definitely Taiwan is one of the most important partners in this context.
Sana Hashmi from the Bush China Foundation. Great to have your thoughts. Thank you very much for joining us.
Thank you.
Cuba is facing severe food shortages in one of its worst economic crises in recent history. Families are now struggling to put food on the table as inflation and scarcity make even the most basic items hard to obtain. As Omar Bakalolu reports, the recent extension of the US sanctions could tighten the grip even further.
More than 60 years ago, Fidel Castro's socialist revolution brought a small Caribbean island to the center of the world. His communist regime promised to provide for its citizens, subsidizing foods, education, and healthcare for millions. But decades of the US economic blockade have pushed those promises into the distant past, as Cuba now faces its worst economic crisis since the collapse of the Soviet Union. Basic staples like bread are becoming harder to find, and when they are available, they leave a lot to be desired.
The problem is that the bread is coming in the same way as it used to. Before that, it was some 80 grams, but it never actually was this weight. It was always below. So approximately now, it's similar as it used to be, but the quality is awful.
Cuba needs 3,300 tons of wheat monthly, but could only secure 600 tons in September. A ship loaded with wheat remained docked because the government couldn't pay for it. The situation is the same with rice and salt shipments.
If you don't have rice on the table, pasta or macaroni, it is not as noticeable. But when there is nothing at all, it hits very hard. Some go to bed without eating anything, just water with sugar, if they have it.
The US sanctions, imposed in 1962 and tightened under the Trump administration, have cost Cuba billions. Although food products are excluded from the trade embargo, the government blames the sanctions for its economic woes.
The cost of the basic food basket for a year is approximately $1.6 billion. That's equivalent to 4 months of a blockade.
Americans don't allow anything to come in here. Anyone who says otherwise is mistaken. And we are the ones who pay the consequences.
Havana says that the economic blockade has caused $164 billion in damage over the last 6 decades. Since 1992, the United Nations General Assembly has consistently passed resolutions to lift the embargo with overwhelming global support. Last year, 187 countries voted in favor of the resolution, while only the United States and Israel opposed it. With the Biden administration recently extending the blockade for another year, Cuba's economic crisis is poised to deepen, pushing Cubans further into daily struggles. Omar Bakalolu, TRT World.
Well, that's all your business news for now. Thanks for watching. The Newsmakers is next.